What's up, investing legends? Today we welcome Jacob Winn to the program. Jacob's path into real estate came after starting his career in the hedge fund world, where he focused on public equities, derivatives, and portfolio risk. But after years of seeing how limited that sector could be for true diversification, Jacob began to shift his focus towards real estate. And today, Jacob is the director of capital markets at Rex, a vertically integrated multifamily investment firm with more than 25,000 doors under management, where he helps evaluate opportunities through a disciplined, data-driven lens while staying focused on markets with strong long-term fundamentals. We kick off today's episode with Jacob's transition from hedge funds into real estate and why his thinking around investing, community, and relationships has changed so much over the last 5 years. Later on, we dive into why so many investors misunderstand alternatives, how to think clearly about cash flow versus equity growth, and what actually matters when evaluating markets, operators, and opportunities in today's environment. To wrap up, Jacob shares his outlook on multifamily over the next 12 to 24 months, how he's thinking about distress, inflation, market volatility, and why buying right still matters more than ever in a market like this. If you're looking for practical frameworks to think more clearly about real estate capital allocation and what it really takes to build durable value in uncertain times, this episode delivers perspective from someone who blends institutional level financial thinking with real world real estate execution. So without further ado, everyone, let's welcome to the program, Jacob Winn.
Welcome to the Investing Secrets Podcast.
Jacob, welcome to the Vault.
Pleasure to be here. Thanks for having me.
It's going to be a good time, man. You and I think we connected originally, on LinkedIn, yeah?
Yeah.
Yeah, and here we are, many moons later. But no, this is great. And just to dive right into it, because things have changed a lot over the last 5 years. And I'm wondering, what's a belief that you have today? What's something that you strongly believe about that 5 years ago you would have argued against? Like, what is something that you believe today that you didn't believe or had different feelings about 5 years ago?
Yeah, I think the first thing to pop into my head is the sense of community, right? We're focused on people. And give you a little context there. 5 years ago, I was in the middle of running my own hedge fund as a one-man office, right? Trying to wear all the hats. And shifting out of that mindset and really focusing on people, relationships is huge, right? And it's paying dividends time and again.
I love that, man. Well, let's dig into that a little bit more. So I didn't know this about you, actually. So you had your own hedge fund that you were running 5 years ago.
Yeah, that was actually my start into finance after school.
Yeah.
Worked at a hedge fund in Denver for a couple years.
Okay.
The whole while had it in my head that I was going to launch my own. That ultimately brought me to Florida and did launch it. Like I said, tried to wear all the hats, and to call that a suicide mission might be putting it lightly. But it was a good experience, a lot learned, all went well, but it was interesting.
That's interesting, man. So, and what was, I'm assuming hedge fund, when I hear hedge fund, typically, we're talking, public equities and whatnot. So, mostly like that sort of stuff, or were you doing any real estate at that point?
Just public equities, primarily in the derivative space. The fund that I was brought in Denver, they brought me in to offset portfolio tail risk, right? Stress test the portfolio, see where there's exposure, and implement cost-effective ways to hedge out that risk. And then that was ultimately the basis for, I wrote a couple white papers on the strategies that I was running, but ultimately used that foundation when I launched my own fund and strategies.
I've always found it interesting, and I don't want to spend too much time on this, right? Because we're talking about your stuff, but this is an alternative investment show anyway, so we could take it wherever we want to. But I've always found it interesting how the average American kind of gets duped into investing into public equities when there's guys like you who they're glued to the computer and they're writing papers, and they're doing you are a master of that craft. For someone to have the audacity to think that they can, just kind of like side hustle their way into making millions of dollars investing in the stock market is, it's fucking lunacy. right? Like, I mean, it makes no sense because they're going up against guys like you, right? And then, and companies like you were working for that got hundreds of analysts and people and everything that are working there. So unless the strategy is just like, I'm going to buy a bunch of stuff and set it, forget it, and never look at it again, like that's fine. But for them to think that they're going to be actively managing and finding a way to beat Jacob, like what are they thinking?
And that's interesting. I think it opens up kind of two avenues of discussion, right? One, which could probably be an episode in and of itself, but the concept that an 18-year-old can open up a brokerage account and even get approval to trade derivatives, yet a lot of these 506C, 506B, you know the restriction. Access is there's some gatekeepers, but the other one being, when I was in that space, seeing, like you mentioned, there's a lot of time and effort and focus that goes into running those strategies. And at the same time, when I was in it and ultimately capital raising for it, it felt like 4 out of 5 individuals that I spoke with actually said, yeah, I don't need diversification just for the sake of it. If you come across anything in real estate, let me know. And so that was a head scratcher for, 4 or 5 years, saying maybe there's something to real estate. And when you dive in and unpack it, there really is, from a diversification, but also tax efficiencies and other elements of investing in real estate. It really is a better alternative than just an active public market strategy.
Yeah. And by the way, I am sure that you're not suggesting to completely liquidate all public, all of your stock positions and everything. Like, I'm sure that's not what you're insinuating. But the average American has over 95% of their investable assets in the stock market, in public equities. Yeah.
Yeah.
And that's a massive, that's concentration risk, A, right? B, you're investing into a system that's controlled by and manipulated, not just controlled by, but manipulated by companies and by like the previous fund that you were working for, right? And I'm not picking on them, I'm just using them as an example, right? Like, there are so many hedge funds and active traders out there, whatnot, that are actively manipulating the market, and you're just going to put 95% of your money into something that's just like somebody else's playground.
Right.
Interesting.
And not insinuating, I think there's obviously a predominant importance for the public market, stock, bond, traditional, call it portfolio. Yeah. But more this concept of, in the basket of alternatives, just an active management strategy within public markets is pretty basic alternative, right? You're taking what the core portfolio for an investor is, and you're just going to active manage in a more finite, space. It's not a very powerful alternative, in my opinion, particularly when you get into real estate and some of the others like tax advantages that I mentioned. You can make a more meaningful impact, offsetting passive gains, passive income, which really don't feed directly into the return metrics.
Let's dig into that a little bit more, because you keep bringing it up, and I think that it's just worth revisiting for folks here. So, if you were to name the 3 best kept secrets as it pertains to investing as an LP into real estate syndications, what are the 3 things that most people aren't aware of, what should be?
Oh man, I think in the basket of LPs, I think it varies based on who you're talking to, right? You've got the scale of institutional to retail, and then different elements of retail and sophistication. But I think the 3 biggest things people miss, maybe not a miss, but rather a hurdle or a hang up, first and foremost in the retail crowd, would be indecision, right? I think they get caught up in this aspect of indecision, which is really, not so much to say that they need to be an expert, but coming in to your due diligence prepared, knowing what questions to ask, what to look for, can really streamline a lot of that process for them. Two, I think would be missing the understanding of where their investment goals are, right? Whether that's total return focus, recurring dividends, tax efficiency. You've got the different brackets that real estate can focus on. And I don't think they truly maximize their goal profile from a portfolio standpoint with the various different asset classes, that are available in real estate, right? If you're targeting a true cash flow opportunity, there's a few asset classes that would be a best fit for you. And conversely, the same with tax efficiencies and on down the line.
In your experience, when we're focusing strictly on cash flow, right? Like let's just focus in on that since you mentioned it. What are the types of asset classes, and I guess more importantly, business plans for those? Because every business plan is different, right? And yields different results. But what are the combinations of asset class plus a business plan that yield the greatest cash returns that you're seeing right now?
Absolutely, and I think cash flow is difficult in the state of this current market. Multifamily, mobile home parks being clear asset classes that do offer consistent cash flow. Even self-storage as an asset class has elements of strong cash flow, but at the same time, you mentioned business plan, and it really boils down to how you structure the capital stack on top of the overall risk profile that you're targeting from a deal, right? Is this bad? Is it new construction, core plus? They're all going to fall onto a different part of the scale in terms of cash flow versus capital gains.
Interesting. So in my experience, because I'll chime in here too. I see a lot of multi deals. I've seen a lot of retail recently. I've had a lot of retail come up and some office. By the way, we'll get back to office in a second because, and I'm not sure how much do you guys do a lot of office at Rex? I don't know. Not really, right?
Sparingly. It's been in conversation, but not at the forefront right now.
Yeah. Office is coming back to me personally. Like I've seen more office deals come that need capitalization. But right now it's just a pure basis play. It's not really like, oh man, we're super bullish on office. It's like, holy shit, can you believe how much, like, can you believe how little we're paying for this thing? Like, right? So it's more of like we can't lose because we're buying it at such an attractive basis. Not necessarily, oh my God, this is going to be a grand slam, deal. So it's interesting. But, and I might be biased here because of my hospitality background, but I gotta say, man, the best cash flows I'm seeing still, residence inns, 11, 12% cash on cash, it's really strong.
And where would you put, equity multiple or equity growth in those opportunities?
So that's the trade-off, right? That's the trade-off. So on a resi deal like that, you might be looking at 1.8 to 2 on an equity multiple. That's project level. You might get a little bit higher than 2 project level, right? But to the LP, I would say that 1.8 to 2 is probably pretty standard. Which, if you think about an annualized rate of return there would be anywhere from like 15 to 20. So there's still some upside, right, to those deals. But the thing with a lot of these hotel transactions is that you buy them, you have to immediately do a PIP, right, like a CapEx on it. And then you're writing it out. By the way, a residence inn isn't something that you want to buy and then sell in 5 years. It's more like something you want to buy and hold for like 7 to 10, because that's how long the PIP's going to last you. And then once the brand mandates the new PIP to be done, that's when you trade the asset, right? After 7 to 10 years. but you're clipping, maybe call it like 12 points a year cash on cash return. That's pretty freaking good. I think a lot of people would be okay with staying in a deal if you're clipping 12 points a year. But then at the end of it, the issue is, Jacob, that you've increased NOI, you've increased obviously the value of the property, but then you got to pass the PIP off to the next guy, right? The CapEx to the next guy. So then that gets baked. So that shaves off some of the margin, right? On the exit. So, that's really, they're stable, but to your point, like, are they stable cash flow plus home run, MOIC or equity multiple? Like, no. And that's the trade-off. I think that's the trade-off that every investor needs to decide, is what's most important to you. Is it cash flow or is it equity growth? Because very rarely in this game do you get both. I mean, it's in theory, it's possible, but like, why would anyone sell a cash flowing asset at enough of a discount for you to be able to grow the equity, right? And so like, you're either buying a property that needs work and isn't going to cash flow for a certain period of time, or you're buying a cash producing asset that is going to increase the value, but not nearly as much as it would have, if there was some sort of value infusion, right?
Yeah. And I think it's that relationship that I do think a lot of retail investors miss, right? Knowing what their investment preferences are and their goals are, for example, wanting cash flow, they maybe misinterpret the equity multiple piece or total return picture.
It's interesting that you say that. One of the first questions I ask every retail investor, which I don't talk to a lot of retail investors right now, but previously, one of my first questions that I asked them is, what's most important to you, cash flow or equity growth? Do you want to know what 90% of them said?
Cash flow.
90+% of both. They all get you. They say, I want both. And you're like, yeah, I want my cake. I want to have my cake and eat it too, but you got to pick one. It's interesting though, because go for it. You're going to say something?
I was going to say, if we could go back in time, 15, 16 years, you might be able to get both, but not today.
Well, yeah, exactly. Exactly. Well, and especially with where rates are at today, right? And to your point, right? Like a lot of these multi deals and whatnot, like, man, they do good now, but it's like a lot of that cash flow gets eaten up by the debt service, right? So, that's really, well, not just multi, by the way, it's every asset class, right? But, yeah. They all say both, but it's, but you're right, man. Prioritizing that and understanding what your goals are in relation to where you're at in life is really important. And I think that having that clarity allows you to make much better decisions for yourself. And it also helps you eliminate a lot of opportunities. Like, if you're super clear on what your goals are, you're going to, like, most of the stuff that gets presented to you, you'll just completely like dismiss it because it's not in alignment with what you want. But it's easy to get shiny object syndrome especially when you don't have a path or a vision for what you want, clearly defined goals.
It's time saver, and huge on the clarity piece, right?
Yeah, man. So let's talk about Rex a little bit. We've obviously mentioned them a little bit there, but you work with Rex. Give us the scoop on the firm and the investment strategy there.
The firm itself, vertically integrated multifamily GP, little over 25,000 units under management. That is broken up, third-party property managed assets, as well as the owned and operated assets in-house. Been around 16 years, and pretty hefty track record, 88 full cycle investments, over 100 total investments. Most of that, 99% of that being multifamily. A couple one-off opportunistic plays, which actually a historic hotel, as well as you mentioned office, a couple small scale office plays in there, but heavy focus right now, multifamily, investment strategy wise, primarily targeting phenomenal locations. So high residual land value, and then assets well below replacement cost. Right. And supply wave playing a big toll recently in multifamily, still see a lot of the aftermath of that. Supply and new starts kind of falling off a cliff, but below replacement costs largely being a measure of, eliminating certain market shocks like that, over the whole period.
And as it relates to, what the future has in store for you guys there, like what are the, are we mostly focusing on certain markets? Are we market agnostic right now? Like kind of like walk me through the business plan on how you're looking for deals.
Yeah, pretty heavy focus. I would say across the Sun Belt, but more specifically Texas and Florida. We are looking at a couple pipeline opportunities in the Carolinas. So I would say Sun Belt with an opportunistic overlay. Also looking at a pipeline deal in Boise, which is a tough market to break into, but we got in 5-6 years ago, small scale, test the waters, get familiar, and then maybe build it out, at scale. But hot on Texas and Florida right now.
Yeah. Any markets in Texas or Florida that you guys wouldn't touch, like any cities or anything that you're like, we like Florida, we like Texas, but we don't like these particular cities?
Not so much. I mean, an easy answer to that really is where we don't have exposure, right? Looked at a deal recently in Tallahassee, right? And we have never really had a footprint there. So that's a tougher conviction play for us.
Yep.
A new market. On the Texas side, one that we really have a hard time touching is Houston. One from a sprawl and zoning risks. But other than that, like I said, pretty opportunistic. We will stay open. I think there's markets that we have conviction in, more so being the focus rather than what we wouldn't touch market wise.
Yeah, that makes sense. Obviously, it's really hard to say. I'm sure in your shoes, right? Let's say we would never go this place or we would never go here. Because look, if the opportunity is good enough, right? Like I have people say like, oh, I'd never go to California. Well, guess what? I know some people that said they'd never touch California that are doing a deal in California right now, because it's like, it's too good of an opportunity to pass up. So I like it's like Sunbelt with an opportunistic overlay. That's a great way of putting it, where it's like, yeah, I mean, we'll go anywhere where the opportunity makes sense, but you also had your box that you kind of start from. Which
and really,
the
opportunistic piece comes in, like I said, new markets is a big one, right? If you don't have the footprint there, you don't have the track record there, one, you're gaining that understanding of the market itself. And so for us being vertically integrated, it's an interesting balance, right? Do you start smaller to test the market, get established, which is tough to do vertically integrated, right? Lower unit count. The economies are a bit tougher. So for us, it really comes down to if we can get, 300 units and up at an outright acquisition, that's enough for us to really plug in, the vertical integration and scale. But it's this trade-off of conviction in the deal versus, the risk aversion of building out in a new market.
Yeah, that makes sense. But I'm assuming that you guys have done a good job of refining that over the years. I mean, say 25,000 units, right? So it's a lot of units. It's a lot of buildings. It's a lot of buildings. I'm wondering, so obviously you've been in this industry now for some time, and I'm sure that you've been exposed to a lot of different like schools of thought as it relates to, either identifying markets to play in, the case for and against vertical integration. What's a piece of advice that sounds really smart as it pertains to our industry, but is actually like really terrible advice?
Oh man,
I know I'm putting you on the spot, bro.
Smart, terrible advice. I mean, you look at the last 5-6 years, even maybe 7-8 years, and there was this huge run up within private equity real estate, right? I mean, everybody piling in, and I think this concept of conveying how to structure these deals and the overall setup and the capital raising, and making it seem like it's a game for everybody. I'm not saying it in very polished fashion, but I think that overarching message that this is a game and an open sandbox to play in, and I really don't think that's the case.
Oh yeah, me neither. I understand what you mean by that, which is like, hey, a lot of people say like, oh yeah, it's an industry that if you just try hard enough, you can succeed. I mean, not really, dude. You have to really have your stuff together, man. You absolutely have to have your stuff together. And I think that I would say that there are levels to this game that are accessible by anyone, right? Like I would make the argument that like probably anyone and their mom could flip a house. They might not be good at it. They might not make any money, but like they could do it. And like a lot of people would still lose money, right? If they did it, but like, so or like wholesale a house, right? But like, there's like, this game has a lot of different levels, but to your point, and I think what you're saying is, and correct me if I'm wrong, but like what I heard you say was like, at this level, not everyone can succeed. And you have to have your shit together in order to do it. And not just that, but you have to have skills, resources,
and really, be committed to the process of building out systems and processes, right? Not just find a property, pull in some friends and family into this, pooled structure and there you go, right? There's systems and processes if you truly want to be successful over the long term.
Well, and it's what comes first, the chicken or the egg. Do you build out the systems first, or do you acquire the property first and then build out the systems? I would argue that the issue that happened, why so many people lost this last up cycle, right, where we saw so many syndicators lose, is because they actually didn't follow that advice, right, Jacob? They kept buying and didn't spend any time to just like press pause and be like, all right, we've got a few, let's dial in the systems for these few, make sure that we're running a tight ship, and then go back and get more, right? Like once we've built out everything, because it's hard to build something out speculatively, right? Like we've got nothing. But to your point, I think what you're saying is like the difference between the ones that succeed and the ones that don't it's not like they didn't, the difference between the successful shops and the non-successful shops is the systems, the processes, and the winning business strategies, right, that take time to develop.
Absolutely. And I think, you mentioned the recent period of turmoil, and I think there's a trade-off too between how you're, again, systems and processes, but how you're looking at the current state of affairs,
right,
objectively, right? And applying, my background, quantitative, applying a quantitative lens to the current state of affairs is always going to give you an objective view of the market, regardless of what, public sentiment. You go back to 2018, 2019, and it was like, multifamily all the way, right? It's hot. You got to get in. Yeah. And, if you, like you said, press pause, take a look at the objective metrics, you see, particularly going into 2020, the level of money printing and monetary policy at the government level. And what is that going to do to, the rate, interest, and inflation? How is that environment affected? And what's that ultimately going to do to commercial real estate? Right. And you look at it and go, maybe now's the time, right here, right now, maybe we should slow down. And as that unfolds, obviously each new day, each new month is more data to make decisions off of. And as you go down that line into 21, 22, now it's okay. This is unfolding maybe worse than we thought. So let's start selling. Let's reduce some exposure. And where are we the most exposed? And so anyway, I'm rambling here, but the quantitative lens, I love it. Right? It's
so obviously now you still have that lens. So let's apply that lens to the forecast now for the rest of this year and maybe beyond that, right? But applying that quantitative lens that you've developed, Jacob, how do you see the next 12, 24 months shaping up for us here?
I think a big one that you probably won't see much talk about or in the headlines, but the geopolitical happenings on a global scale, I do think is going to take oil higher, which has generally been an inflationary gauge historically. So I do think we're going to see persistent inflation, which is going to be persistence in this higher interest rate world that we're in, which does, ultimately mean headwinds for multifamily and all of commercial real estate. And I think that's for the foreseeable future. I think that's the environment we're in. And so the game becomes, set your underwriting assumptions and stress test those accordingly.
You don't think Venezuela's going to save the day, man? You don't think we're going to start pumping oil? I'm just kidding. We're not getting political on this show, guys. I need everyone at home to calm down. All right. I had to get that one out of the way. But seriously, right? It's like, I actually agree with you. I think that, I don't think anyone would disagree that the geopolitical climate right now, is concerning, from an economic standpoint, just because, in times of war, there's always going to be economic consequences. So what that looks like for real estate, I guess, TBD. But I don't disagree with you there. I don't disagree with you, but it's also hard to know, because we're a few weeks into this. It could be, hopefully it doesn't last a long time.
Right.
Obviously.
And I think too, in a quantitative sense, you're familiar with all the variables and what goes into, underwriting a potential deal. Right. When you look at any one of them in a vacuum, it's tough to build, true conviction, right? You've got, particularly in multifamily, you have other elements of, distress that are showing through, going from a low rate world to a high rate world, and the debt maturities that are looming. We're starting to see some of that trickle through into the market. We do think that will open up more as we get into the second half of this year, and then, onward into 2027. I think the, debt maturity, quote, tsunami that was talked about, in recent times, I don't think that's the way it's going to play out. I do think it's going to be, more of a slow bleed. And so it all boils down to, potential opportunities and capitalizing on them.
Well, the thing about the debt maturity, crisis, right? That quote unquote crisis that we were going to experience, that started in 2023. That conversation started in 2023. And there were a lot of maturities that came and went. should have already happened. The reason it didn't isn't because it didn't. The reason is because the lows didn't mature, right? And it's not because the environment loosened up or like, you know, that we got. No, the reason is because there are just a lot of backward deals that took place. A lot of backward deals. So it, and what that proved to us, at least I think what it proved to us here in the real estate community and our industry as a whole is, and I think the problem with it is it sets a precedent now moving forward. We're like, oh, well, you know, like we'll always be able to work it out. And sure, I mean, like, it's nice to know that, but it also, I think, promotes bad behavior moving forward. And I think that's a risk that we kind of take on as an industry moving forward.
Absolutely.
You know, so also concerning, like also concerning. But to put a bow on that conversation, cause it's not all doom and gloom. I do believe that great sponsors, who adhere to, and have great fundamentals, right? And have dialed in business plans and have a proven track record. I do believe that those groups will continue to thrive regardless of what happens with, you know, sure. I mean, thriving is subjective, but let's be real, right? Like, if you're worried about the war in Iran, right? And you're like, hey, we're not going to invest, because of the war in Iran. It's like, well, is your money going to sit, is it going to be like under the mattress? Because whatever happens, I think is going to be felt evenly, right? Across various asset classes. Unless you're invested in oil, right, Jacob? So what I'm hearing is that you just got to put all your money in oil. The barrel price is going to double.
Sticking with real estate.
Yeah, no, I hear you, man. Me too. No, but to put a bow on that, I mean, I think that fundamentals are crucial, and the good players will continue to get rewarded, even if we experience a little bit of turbulence, you know, in the coming months / years.
I agree. I think there's plenty of opportunity out there. It's really going to become a game of operations. Right, operational excellence, but the opportunities are certainly there, and like I said, you know, we're seeing more and more of them coming to the table.
Absolutely, man. Well, look, we're coming up here close to time, so before we kind of get to the back end of the show here, if the listeners at home want to get in touch with you, learn more about Rex and investment opportunities with Rex, how can they get in touch with you and move that conversation forward?
As far as social media, you know, I do have a LinkedIn, as well as Instagram, though Instagram is more personal rather than business, but I can definitely find me on LinkedIn.
Awesome, man. Well, we will put that in the show notes and in the description down below. I had a couple questions here for the wrap up, but we've actually gone through all of them. We covered a lot, man, in like a little bit of time. You know, I was going to ask about like projections here for the market, over the next couple of years, but we've already covered that. So we're good, but I won't let you leave the vault, Jacob, before you leave the audience with one final investing secret. Take it away.
Ooh, the best investing secret or advice. I'm going to have to go with buy right. Purchase right. Right. And it reminds me of the Warren Buffett quote, price is what you pay, value is what you get. Right. And it's this concept of, hey, would you prefer a great asset at a fair price or a fair asset at a great price? And at least for us, you know, we go with the great asset every time because, you know, ultimately searching for value. So buy right, be golden rule.
Love it, man. It is a great rule. And I think even going back to the conversation about office earlier, it's like, why are people suddenly really optimistic or excited about office? It's because the basis that you're able to get these things at right now. So they're buying them right. And it's hard to know in this environment what the right buy is for some of these asset classes, because values are weird right now, to say the least. So if you can find a good opportunity to buy right, I would absolutely agree with you there. That that's the best way to protect value is to buy right. So love it, man. Jacob, thanks for stopping by. Thanks for joining me in the vault, brother, and look forward to your continued success and the success of everyone over there at Rex.
Yeah, it's a pleasure. And thanks for having me.